An 85-year-old Wall Street titan, completely evaporating in a matter of days. Welcome to this explainer. We're dropping you straight into the climax of the most spectacular, edge-of-your-seat financial heart attack in history. $2. Yeah, you heard that right, just $2. That is the unbelievable fire sale price per share JPMorgan Chase initially paid to swallow Bear Stearns whole back in March 2008. But to really grasp the sheer shock of that number, you've got to see what came right before it. Because just a little over a year prior, in January 2007, this exact same stock, it was trading at a towering $172 a share. We are talking about an absolute empire here, which begs the immediate, terrifying question, how on earth does an institution of this magnitude just vanish that fast? Section 1. Building a Wall Street Titan. To truly appreciate the velocity of this collapse, we have to brag a little about the massive pedestal this firm was standing on. Founded in 1923, they survived the 1929 Great Crash without a single layoff. Fast forward to 2007, and they're a global juggernaut with 15,500 employees. They were the fifth largest U.S. investment bank, literally crowned Fortune's most admired securities firm. But you know what? All that prestige couldn't stop the poison that was quietly lurking in their books. Section 2. The subprime time bomb, a ticking disaster. Look at this jaw-dropping disparity. Beneath the awards and the shiny Manhattan headquarters, Bear Stearns was supporting a staggering $395 billion in total assets. But their net equity? Just $11.1 billion. They were building an incredibly precarious multi-billion-dollar house of cards. To put that into perspective, that means their leverage ratio was an astronomical 35.6 to 1. They were borrowing incredibly heavily to bet big, leaving absolutely zero margin for error. If the toxic assets hiding deep within that massive portfolio lost even a fraction of their value, it was game over. And here is where it gets crazy. They were carrying over $28 billion in highly illiquid Level 3 assets. For those who follow the markets, you know what that means. These are financial instruments that are almost impossible to value and even harder to offload quickly. The moment the subprime mortgage market began to crack, the countdown to destruction officially started. Section 3. The contagion begins. The first real cracks in the dam didn't actually happen in 2008. In a rapid domino effect starting in June 2007, Bear Stearns desperately pledged $3.2 billion to bail out one of its own failing subprime hedge funds. Talk about a massive red flag. By July, those funds lost nearly all their value. By August, furious investors are filing lawsuits, and by November, Bear Stearns reported its very first financial loss in 83 years. But the true terror, the moment Wall Street realized something was fundamentally broken, hit when Merrill Lynch seized $850 million of Bear Stearns collateral. And get this, when they tried to auction it off, they could only find buyers for $100 million of it. It proved to the entire market that these subprime assets were basically radioactive. The immediate fallout from that was brutal. Co-President Warren Spector is forced to resign. S&P slashes their pristine credit rating, net profits absolutely plummet by 61%, and 2 hedge fund managers eventually face criminal charges. There was blood in the water, but the real massacre, that was still a few months away. Section 4. The chaotic unwinding. 72 hours to total collapse. Watch this catastrophic timeline unfolds because it's wild. On March 10, Bear Stearns had a perfectly healthy $18.1 billion liquidity pool. But as rumors of a cash shortage spread like wildfire, counterparties just panicked. In a frantic 72-hour window, that massive liquidity pool evaporated down to just $2 billion by March 13th. This forced a literal, desperate 911 call to the Federal Reserve. Fearing a chaotic unwinding that could take down the real economy, the Fed stepped in and orchestrated a shocking, unprecedented rescue. Step 1. They set up a company called Maiden Lane LLC to absorb $30 billion of Bear's toxic assets. Step 2. The Fed funded it with a $29 billion loan. And Step 3. This cleared the way for JPMorgan Chase to swoop in and buy the remains of the firm for pennies on the dollar. Now, remember that unbelievable $2 a share offer we talked about at the very beginning? Well, thanks to a hastily written contract loophole and some fierce shareholder outrage, JPMorgan was eventually forced to bump that buyout up to $10 a share.
But honestly, the damage was already done. An 85-year-old financial titan had essentially been erased from existence over a single weekend. What makes this explainer so utterly chilling is this exact conclusion from SEC Chairman Christopher Cox. He stated flatly that Bear Stearns wasn't actually killed by a lack of capital. No, they were killed by a sheer, self-fulfilling lack of confidence from the market. The exact second their trading partners stopped believing they were solvent, those rumors became a fatal reality. So, as we wrap up this look at an absolutely unprecedented collapse, I want to leave you with this final, provocative thought. If a deeply entrenched, $395 billion Wall Street titan can be utterly destroyed in a matter of days simply by panic and rumors, just how fragile is the rest of our global financial system?